Hello, I'm Jeremy Allaire, and welcome to the Money Movement. I'm really pleased to be here in Paris, France, as part of Paris Blockchain Week and Circle Forum Paris, a very special time. And also very excited to have as our guest today, Circle's chief economist, Gordon Liao. Gordon, it's great to have you here.
Thank you so much. It's a pleasure to be here.
There's so much happening that impacts your world, our world together. I want to kind of introduce you and have you introduce yourself a little bit to the Money Movement audience. You found yourself as in applied math at Harvard and navigated your way through some pretty significant roles in financial risk, the Federal Reserve, into crypto, into Uniswap, and now here with Circle as our chief economist. Most, I think, people think about chief economist roles in large banks, in asset management firms, in assurance firms, things like that. I don't think people realize how vital the role of chief economist is in a kind of financial infrastructure company like Circle. And so maybe just start a little bit with your journey into this whole space, but just more broadly, a little bit of your journey, and then I want to kind of land back at the kind of foundational role that you're playing as Circle's chief economist.
Sounds good. So early on in my career, I started my career as a trader and portfolio manager at the Harvard Endowment. And it was there, trading fixed income instruments, doing fixed income relative value trading, where I first saw how segmented markets are, various types of spreads all over the place. Part of that was a reflection of constraints on balance sheets of large intermediaries. And that really got me to go on this journey of studying market intermediation, understanding it from a policy angle, and later on understanding it from a practical angle of how to address market intermediation frictions. Mm-hmm. So fast forward a couple of years, I was doing my doctoral program in economics at Harvard. And that was when I was first introduced to Bitcoin. It was 2013. A lot of my really smart friends at Harvard was mining Bitcoin on the side. At the time, I thought, this is quite interesting, but the application seemed rather limited. Sure, it's a store of value of some sort, but it was also highly speculative. It was not until a couple of years after, when Ethereum really took off, I saw this amazing promise of programmability that could replace some of the intermediary functions that are traditionally fulfilled by large banks or large broker-dealers. Yeah. That really got me excited. Now, when I was first introduced to the concept of stablecoin, or started paying attention more to it, was actually when I was serving as an economist at the Federal Reserve Board of Governors. In 2019, when the concept of Libra, and later on called DM, was first introduced, central bankers really paid attention because it is something that at the time it seems like it could have challenged monetary sovereignty, with the basket of currencies being the backing of that particular type of token. So at that time, I really got involved and started paying more attention and led some of the early work streams on stablecoin, understanding both its potential, but also some risk associated with it.
You've published and provided, in a sense, advice to the Board of Governors on this critical topic of the safety and soundness elements of stablecoins, different models for how they could work.
Yeah, and I think there's so much more work to be done on that front. And fast forward around 2020 and 2021, when the DeFi summer was occurring, every week there's new protocols, new innovations coming about. And from someone who have both traded in the traditional finance world and have looked at market segmentations and frictions from a policy angle, this just seems like a really cool opportunity. And at that point, I jumped into the deep end and went to Uniswap to lead their research team and worked on mechanism design, really dived deep into smart contracts. It was last year when Terra and Luna happened, that's when I realized, stablecoin is so core to this infrastructure that we're building up in decentralized finance. So having a well-backed, fully regulated stablecoin is fundamental to not just the DeFi industry, but also to this evolution of transforming finance to reduce some of the financial risks we have seen in the past. So that's when I decided to join Circle, and so far it has been an amazing journey to work on the economic agenda for Circle, to think about the long-term business implications, business model of our USDC stablecoin and how that would potentially interact with both traditional finance as well as with central banking.
That's awesome. There are a lot of directions we can take the conversation today, and this episode is in the aftermath of a near collapse of a significant piece of the commercial bank arena in the United States, with cascading issues continuing over the weekend. The emergency bailout of a systemically important bank, Credit Suisse. More pins to drop. I don't know, needles. I don't know what the shoes to drop. Who knows? And so it really sheds a light on this whole question of risk, this whole question of, if you want to have a digital fiat instrument, if you want to have a digital dollar that can take advantage of things like programmability and internet and blockchain infrastructure, like what's the appropriate design of that? And you've written about kind of the macro-prudential risks of tokenized cash, which is a phrase that you use and we use to differentiate between tokenized, say, deposits, which is what a bank might issue. But maybe just start by talking about tokenized cash. What does that mean, AKA stablecoins, right? A properly designed fiat stablecoin that could exercise its role as a kind of tokenized cash. Maybe define that a little bit, and then we can get into sort of the risk characteristics and kind of monetary policy considerations as well.
Yep. So tokenized cash is a term I use to refer both to the asset side that is backing USDC, but also the liability of USDC being a form of digital cash. So on the asset side, as you know, USDC currently is 80% in T-bills, backed by T-bills, and 20% in this cash equivalent deposit accounts at various banks. Of course, in the future, hopefully we'll see that 20% being eventually replaced by direct government obligation, perhaps a Fed master account, perhaps directly having access to the central bank liability. And that would be making up the asset component of the cash backing. But I think it's equally important to think about what exactly is tokenized cash replacing from a liability standpoint. Usually, money is a form of liability of someone. And typically, most of the money in circulation, M2, are liabilities of commercial banks. So those are deposit accounts. And for central banks, there's also a huge component of central bank liability, which is the physical cash that's in circulation. In the United States, physical cash in circulation accounts for roughly a third of our Federal Reserve balance sheet. That's about $2.3 trillion, of 80% of which are $100 bills. I see tokenized cash as a way of replacing, first and foremost, those physical cash that's in circulation, those $2 trillion plus of $100 bills that's in circulation, that's being used for various purposes, both as a store of value, but also as a means of payment. So it's really a combination of both speaking to the full reserve, safe asset backing of high-quality short-term assets, as well as the liability component that it is trying to replace the physical cash that's in circulation with something that's more digital and 21st century.
That's a helpful view. I think one of the things that there's I think generally a lot of confusion about, and you see this in the media, and you see this in crypto Twitter, and you sort of see this even in policymaking circles, where you have policymakers who have sat on banking committees and other committees for a really long time, but kind of seem to miss some of the really fundamental issues of risk. And so, I think one of the big questions is around, liquidity and redeemability and and kind of comparing the risk of what we think of as well-regulated bank money versus the risk of a stablecoin that is designed in the way that you've just described. And I think in one of your papers, you really focused on this sort of, if you applied the kind of risk framework that's applied to banks, the Basel III kind of liquidity coverage ratio, kind of model, and maybe you could define that in simple terms for the audience. But if you compare the kind of the risks that exist around the kind of liquidity in, say, traditional banking versus a full reserve digital dollar, there's some fundamental differences, and I think that skews people's view on this.
Yeah. So one of the papers I released last year was called Macro-Prudential Considerations for Tokenized Cash. The core part of analysis there was actually comparing this liquidity coverage ratio, which is a ratio of how much high-quality liquid asset there is relative to the expected outflow of deposits in the next 30 days, which is a very typical measure for prudential regulators to assess risks at various banking organizations. By the way, LCR, which is a Basel III implementation, actually doesn't cover, it's not actually required as an assessment for some of the smaller banks. So I think SVB was actually not examined in that particular way. But looking at the comparison of how USDC reserves are composed, which is 80% T-bills, 20% cash equivalent at banks, that liquidity coverage ratio was actually somewhere, depending on how the assumptions are defined, roughly 2 to 7 times the amount of a typical large globally systemic important bank. That means that USDC actually has quite a lot of liquidity, and this speaks to the ability for Circle to redeem, to issue stablecoin, to issue USDC at parity at an ongoing basis. And the ability to do so is only possible because we hold such high amount of highly liquid short-term T-bills with maturity of less than 3 months.
That's it is really a key piece. Is sort of in some ways what we saw happen with the collapse of SVB, and we're sort of seeing emergency measures by the Federal Reserve to backstop the entire uninsured deposit base of a huge tier of commercial banking in the United States. It kind of gets to this point that the real risk is the maturity mismatches or the lending book risk that commercial banks have. And in fact, in this circumstance, it was the banks that imported risks to the stablecoins, not the other way around, which everyone's sort of saying, well, we're going to need to worry about stablecoins, and their impact, or crypto's impact on the banking sector, is actually a little bit the reverse. But it does get to, I think, this kind of core question, which ties back to the work you've done in tokenized cash, which is, what is the ideal design of a tokenized cash instrument that can gain the benefits of private sector issuance, private sector technology innovation on these constantly upgradable blockchain networks, participation in the programmability and openness of programmability that can drive all this innovation at that base layer? How do we get a design? How do we improve the design so that the world has access to a digital dollar infrastructure that can avoid this commercial bank risk, can avoid all of the massive risks that commercial banks are importing into our payment systems?
I think this is something where we continue to learn and grow as well as a company. One area of improvement that requires federal regulation in the US to actually enhance is a direct access to the payment rail. So we have to hold a certain amount of cash liquidity buffer at commercial banks today because we rely on commercial banks to fulfill the transactions for minting and burning conversion to fiat. Because the access to FedWire, to also the forthcoming FedNow system, are exclusive to banks today. And that's a very unique thing for the US. For instance, many other countries have opened up payment access, payment rail access.
I was literally on a video call with a central bank this morning who is opening up their real-time payment system to fintechs and to allow for that greater velocity of innovation.
Yeah, and I think you mentioned, this time is actually an example of not crypto importing risk into banks, but banks importing risk into crypto. I think going further, I actually think that thinking about innovative payment solutions such as USDC is actually a way to reduce the amount of systemic risk in the overall banking system by replacing part of those uninsured deposit base with something that more or less resembles a short-term fund structure in which you have also the alternative payment rails that's directly connected. So I see, one possibility of just reducing this overall risk of too big to fail in the banking system by helping the banks to focus on their core competency, which is, of course, credit intermediation, some form of liquidity transformation. At the same time, stripping away some of the unnecessary parts, such as payments, that, if you think about what happened with SVB, one of the main issues that was at the heart of what people were worried about is for firms to meet their payroll obligations the following week. Of course, I think payroll and payment, that sort of narrowly defined set of services doesn't have to be linked to banking and could in fact be separated out and make those banks stronger in doing what they're good at, which is credit intermediation, and replacing part of what they do not necessarily need to focus on, which is payments.
This goes deep into the heart of contemporary kind of bank monetary theory and regulatory practice, right? We've talked on the money movement in multiple episodes about the Chicago Plan, which of course was in the aftermath of the Great Depression and all these mass bank failures. And at that time, the Chicago Plan, which was a prominent group of economists suggesting a separation between the business of lending and the business of kind of government-assured money and payment systems. And the argument was that would actually lead to a more less risky financial system, and that was less prone to booms and busts and recessions. And of course, instead, there was mutualized insurance was the answer, right? Well, we're gonna run all this together. We're gonna bundle it all together, and if there happens to be a risk, we'll just have insurance. And that was the birth, of course, of the Federal Deposit Insurance Corporation. And I think that was the bank's preference was we don't want to let go of this. We want to do this. Fast forward, savings and loan crisis. Again, this issue became one that emerged. And then again, after the financial crisis, I think there were real discussions about this, and that played itself out into things like money market. Dollar money market structures and backstops on these, and now today, it's this has been for us, a core philosophical tenet of USDC and of our belief in what dollar digital currency should be is this clear separation between the payment system and the payment infrastructure and the underlying kind of liability or assets that you have. And then that kind of credit intermediation piece. And it seems like right now is a moment where, kind of governments could get this right. And in a world of very high velocity, money transmission in digital currency form, it seems more important than ever to kind of get this right. And would love to hear your reflections on some of that.
Yeah, so you're absolutely right in pointing out, historically, we considered the separation between banking and payment functions multiple times. But every time when it comes down to it, we kind of took the path of, we'll just put up more insurance for the banking sector, and also at the same time more regulation, by the way, which actually constrains banks in many ways. For instance, FDIC insurance costs is likely going to rise because what we just saw. There's likely going to be a rise in FDIC insurance costs, which actually distort market in some sense. There are very well documented research on how FDIC insurance costs distort the short-term funding market, the spread between what is known as the Fed fund market rate versus the interest on excess reserve that requires arbitraging out by actually foreign banks and not based in the US. So along the way, every single step of the way, banks get larger, and there's more layers of regulatory scrutiny put on top. And more recently, there's an announcement of the mid-sized banks will get more scrutiny. And along the way, you have more market distortions of various forms. So in the environment which we're in, where balance sheets are getting larger for both commercial banks as well as for the central bank, the only way to actually reverse this trend of ever-increasing balance sheet is to think about drastic changes that involves potentially separating out some of the functions of banking. So if you look at the balance sheet of SVB before it collapsed, it's quite interesting to see that the vast majority of assets it was holding was long-duration treasuries and MBS securities. That's more than half of its asset holdings, against which it was the vast majority of deposits or uninsured deposits. I think it could very well be argued that that they're not really fulfilling the traditional way of banking in terms of making self-information intensive type of loans. Rather, they kind of resemble a fund structure that has just marketable securities against uninsured deposits. I do think this is a critical time for regulators to reflect on, should banks be that large if they're just holding securities that could be held in a bond fund or a money market fund, or perhaps through decentralization in a structure such as a compound or Aave type of platform.
Right. So we're getting to this place where there's potential legislation to define a payment stablecoin and to define it in a way where it's federally supervised, has access to the Fed's accounts and payment rails, and could hold nearly all of its assets in these both short-term T-bills and in sort of Federal Reserve account cash. That seems like it could be the safest kind of digital dollar in the world, and that would be something that businesses, households, people who want to build it and integrate it into their programmable wallets and smart contracts and so on, that could be the right kind of foundation. But there's this other alternative that we're hearing proposed of, instead of tokenized cash, let's have tokenized deposits. And a lot of banks are out, saying, hey, this is a way to go. And even central banks are saying, well, we could have tokenized deposits. It seems like, to me at least, the idea of tokenized deposits is just taking that same embedded risk and transferring it into a token that's on the internet, and that seems even more risky. I think maybe just comment on the risks of tokenized deposits and the challenges with those versus a payment stablecoin or tokenized cash model such as USDC.
Yeah, so even before this recent collapse of SVB and some of the other banks, I think tokenized deposits as a concept already raised questions of how stable would it be when you have basically tokenized fractionally reserved banking on top of something that operates 24/7 on the blockchain. Because we've seen how the deposits are traded also on traditional markets in which there is a spread. They're not always priced one-to-one in the sense that there is differential interest rates. In the Fed fund market, there is quite a large spread between the interest rates are paid on deposits of some of the worst quality banks versus the higher quality banks. So even before this round that happened on SVB, we already observed this. But this recent collapse of SVB really crystallized the idea that combining something that's fractionally reserved with just modern communication, digitization, the fast speed of social media, would just accentuate any sort of round type of scenario. So having tokenized deposit on blockchain where it is operating 24/7 at the speed of light, and you have basically a relatively illiquid asset base, I think it's a recipe for an unstable stablecoin in many ways. So I think regulators need to look very closely and study from this experience of what happened with SVB and what happened with some of the other banks to really see, does it make sense to tokenize something that is inherently less sound from a liquidity standpoint. Also inherently has issues with transparency. Let's remember that for most of blockchain, and also USDC, there's quite a bit of transparency built in with reserve attestation. Right now for USDC, we have this daily reporting from the USDXX fund. But for banks, oftentimes the filings are once a quarter. And that lack of transparency also raised quite a bit of issues with how runnable those will be when those reports are only coming in once a quarter.
Yeah, certainly the money in the bank does not have the same transparency as sort of current practice in stablecoins. But I think one of the other big questions that often gets raised is, or objections is, well, if you have such a safe instrument, such as a USDC that's basically held in T-bills and in true cash equivalency with direct Federal Reserve access, to the market, I think they say that's a huge innovation, a digital version of that can be woven into, as a medium of exchange and as a unit of account and as something that can be woven into the building up of internet-based financial systems. I want to come back to that. But the sort of objection is well, everyone will just want to, hold their money there in times of crisis. And you've also done some research on this kind of question of the ability for an instrument like that to not disrupt the kind of existing kind of money multiplication goals that the central bank has. And part of that I want to come back to is sort of the money velocity and the credit intermediation that is possible with a digital dollar like a USDC. But let's put that aside. Maybe just first address this sort of concentration of de-risking that people talk about.
Yeah, I think credit intermediation is always on the mind of central banks. That commercial banks fulfill this role of intermediating credit, and this is something that I raised as well at the Federal Reserve. If stablecoins get way too large, then potentially it could compete with deposits. But I don't think we're nearly as close to that situation. Again, overall amount of stablecoin circulation is less than 200 billion, versus the first area where I think stablecoin would actually compete with is cash. That's again in the US is more than 2 trillion, and globally is multi-trillion dollars. So I think by replacing some part of the physical cash in circulation, instead of crowding out deposits, you can actually crowd in deposits because you're converting the physical cash into a digital asset where it's backed by T-bills, it's backed by central bank money. Well, to purchase T-bills on the other side, of course, this T-bill sellers most likely will deposit the proceeds back into the banking system.
Yeah.
So I think in many ways, it is so far away from crowding out deposits, rather it's more than likely to crowd in deposits, and that's actually beneficial for the banking system.
And so there's trillions of dollars of bringing in deposit value is sort of the argument at a base layer. I think the other piece of this is again, for a lot of people, a leap of faith. But as someone who's worked in DeFi, worked in intermediation that can be software powered, I think one of the things that we're very excited about is if you have this base layer of money on the internet that is like a straight through kind of government obligation money in a digital form that can be tokenized and then works on these blockchain networks, you actually have an incredible material to build with. And for the first time, really ever, credit intermediation can actually become something that is in many ways safer than it is in the existing banking system, where you can have blockchain-based software which provides credit intermediation mechanics risk mitigation that's provable, auditable in real time, market access on a global basis to participate in these nascent credit pools that essentially could achieve internet scale, and so sort of decentralized or hybrids of sort of CeFi, DeFi, but on blockchain based credit intermediation, combined with the fact that money velocity with a digital dollar that, like you said, moves at the speed of light and has a transaction cost approaching zero, you have the ability to essentially have the sort of the combination of those actually, I think, theoretically achieve the money multiplier goals that a central bank has, which is about stimulating economic activity, to achieve similar goals without having money creation happening and fractionally reserved kind of behaviors. And just maybe talk a little bit about what you're seeing in credit intermediation that can be done entirely in a tokenized cash instrument versus in the legacy fractional reserve banking system.
Yeah. So whenever I think about decentralized finance, and people have different definitions, how I define decentralized finance, a critical piece of it is the decentralization of balance sheets. And yeah, I would say even before going into the tokenization of cash and the usage of the blockchain rails to enable on-chain credit lending, we're already seeing a decentralization of balance sheet occurring in the traditional banking sector, in that most of the banks today originate loans and they syndicate them, and then they move off balance sheet, or they hold syndicated loan themselves. Right? So in many ways, banks are already on this trend of decentralizing away their balance sheets, not that they hold on to portfolio loans anymore. And I think the ability for blockchain, for tokenized cash to come in, that just speed up that process of decentralization of balance sheet for these traditional intermediaries. So I think, yeah, absolutely. With the amount of information that one could also gain from payment activities that are recorded on-chain, you're able to enable these previously unattainable type of lending that use information from, for instance, whether a firm have settled their invoicing for a particular trade, whether the importers, exporters have received their goods, maybe potentially with Internet of Things building.
Right. Transparency, auditability, real-time visibility, just not possible in the opaque banking system that we have today, unless you're able to be a unique firm that sort of stands in a centralized data collection to do that. But this could make that the risk decisioning, right, that goes into something like credit decisioning be much more accessible.
Yep, it is open banking, but way beyond the limited form of open banking that some of the countries try to experiment with APIs. Rather, is open banking where every developer out there could access, could build on.
Yeah, so maybe ties into another topic that I know you've been thinking about as well, which is all of this data and all this transactional data out on the internet. And we sort of see these issues in just the movement of companies' operations to the internet, the data security and privacy and all the risks with cyber sort of attacks and everything else. I think one of the criticisms of, well, if you have these open blockchains and you have all these transactions, isn't that actually going to erode privacy? And for a corporation, right, if anyone can see like all my invoice flows, like that's a huge competitive issue, and so on. And what do you see as the sort of technology solutions that are kind of emerging now and on the horizon that can help provide a degree of privacy, but also maintain compliance that's important for corporations and financial institutions, and kind of unlock some of the use cases you just described, but kind of with greater security?
Yeah, it's always a delicate balance between how much privacy to provide versus how transparent you want to make sure that there is no illicit financing and some degree of fraud or hacking going on. Right? I think for a privately issued stablecoin, we're actually at a place where we could drive a lot of this innovation. So Verte, for instance, being one of the protocols for decentralized identity, is part of that perhaps solution. But there's also many other things going on. Very exciting developments in the space of using ZK technology, zero knowledge proof, to verify transactions in a privacy-centric way that still have a viewing key for regulators if needed. Right. I think that does, the idea of having everything being run by the central bank or by the government, I think it's just too much of an easy target. One for hacking type of activities, but also for the protection of privacy.
So you could have, let's say I'm Corporation X and I'm doing all my internet finance and commerce using blockchains and stablecoins and smart contracts and others. I could, in theory, using these kinds of protocols that use zero knowledge proofs, I could, in theory, for example, provide a viewing key with the appropriate kind of data sampling to my auditing firm who needed to kind of verify transactions, or I could potentially provide a viewing key to some access to that to a credit pool that needed to be able to access some of that to actually make recommendations or decisions around the issuance of credit or other things. And so, or if the financial institution that actually provides the digital wallet, business wallets, let's just say, for the business, they might have an obligation, to be able to kind of do transaction monitoring and determine if something's a problem, but without seeing everything, and or large or suspicious transactions or other things, and then kind of cascading levels of kind of disclosure as needed. It sounds like you're describing a system a little bit like that.
Yeah, absolutely. And that viewing key could potentially be useful for some of the regulators as well when they need to investigate certain type of activities with the appropriate court order, but not at any time at their whim. So I think that sort of structure of balancing between privacy and security and ability to have some level of user supplied transparency, I think it could go a long way, not just in finance, but also you just think about, this is the difference between Web 2 and Web 3, in that Web 3, you're owning the data, not just having your data being owned by some very large tech company.
Right, totally. I know in your role as Circle's chief economist, you're engaged with central bankers around the world, you're engaged with supranational policymaking bodies that are looking at the whole international monetary system and these emerging issues with the recent turmoil that we've seen and the kind of commercial bank risk importing itself into something like USDC. What's your message to those central bankers? What's your message to those leaders of the international monetary system? What are you saying to them today?
Yeah, so to the central bankers, to get back to the goal of balancing between the dual mandate, the fighting inflation and balancing between unemployment, to address the systemic risk, you had to address the root cause. And the root cause of systemic risk in part is concentration of risk in large financial institutions. And that could only be addressed through more drastic overhaul of financial system. I also do think that central bankers have been talking about and have been trying to shrink down the balance sheets of their central banks, their own balance sheets, which has caused some issues in the past. The only way to actually make a change and shrink down the balance sheet is actually by unbundling payments. If you look at how the Federal Reserve balance sheet look like, to reduce the asset holding the Fed has, it has to reduce the liabilities first. And to reduce the liabilities, there's two of the three components of liabilities is rather large. That's all related to payment. One is this, $2.3 trillion of physical cash in circulation. The other one is this, around $3 trillion of reserves, excess reserves that are basically the commercial bank's checking account at the central bank for the purpose of fulfilling intrabank payment, intraday payment for interbank payment activities. So to effectively get the balance sheets of central banks back to a more attainable size, that doesn't raise questions about their independence. I think it is really important at this particular moment to re-examine some of the rules related to access to payment, related to unbundling payment services. And it's only by addressing the financial stability risk then they could then tackle the price stability risk that we face today.
Incredible. Gordon, great conversation. It's obviously a pleasure to be working on all these issues together with you, and I'm so glad you could join the Money Movement today for, I think, a really important set of conversations that hopefully listeners and policymakers and others will tune into as well. So thank you.
Thank you so much. It's been a pleasure.